Good morning. You're watching All You Need to Know on BloombergQuint. Today, of course, is Budget Day. I'm Alex Matthew. First, the headlines this morning. Finance Minister Nirmala Sitharaman presents her second union budget today. The budget speech begins at 11 a.m. India revises its FY19 GDP growth forecast to 6.1% from the earlier 6.8%. GVA, or gross value added growth, has also been revised to 6% from the previous 6.6%. India's fiscal deficit rises to 132.4% of the FY20 target. Core sector growth, however, returned to the positive territory after a negative print for 4 months. Hindustan Unilever and ITC reported results that met street estimates. HUL reports a volume growth of 5% compared to an estimate of 4%. And the death toll from the coronavirus rises to 258, with cases on the rise. The Air India flight has landed in Wuhan to rescue stranded Indians. Now, we're just hours away from Nirmala Sitharaman's second budget speech. From fiscal roadmap to reviving growth to boosting consumption, the finance minister has her task cut out. So, will she maintain the fiscal glide path, or will she bite the bullet and bring us another dream budget? Ira Dugal sums it up in this report.
The budget now just hours away. Important to focus on the big picture and what we would be watching for here at BQ. Lots of interesting details will come through in the fine print, and we will bring you those. But here are the headline issues to be watching out for. As always, the fiscal deficit will be all important this time around, particularly because the sharp drop in nominal GDP growth that we've seen during the year, which has went very weak. Tax collections, expenditure cuts, so they came in towards the end of the year. So almost everybody expects the government will not be able to meet its budget estimate of a 3.3% of GDP fiscal deficit. What will the number finally settle at? Well, the expectation is between 3.7 to 3.8%. But there is a range there because people still don't know what the final tax collection numbers will look like. This time around, non-tax has seen two aspects. You had larger than expected contribution from the RBI's dividend, but a shorter than expected contribution from disinvestment. So all of that math will add up to something like 3.7 to 3.8%. Now, I haven't put in a budget estimate for FY21 because so much depends on where the final number ends up at. If it ends up at 3.7 to 3.8, how much consolidation will the government pursue in a year when the economy is weak? That's a big point of debate. Economists are ranging from a 3.7 FY20 number going to 3.5 in FY21. Others saying that you will end up at somewhere around 3.7 to 3.8, and then you would probably stay there in FY21. So lots of debate. That will also link into the borrowing amount. The market is expecting a gross borrowing amount of somewhere in the region of 8 lakh crore. So that's the broad expectation. But, this time around, you could go way off or you could be absolutely on point. There is also going to be an interesting debate which may not eventually play out. But, the FRBM review committee had allowed the government something called an escape clause. Essentially, under times of extreme stress, war, structural change, or a sharp fall in growth, the government was allowed a 0.5 percentage point escape clause on the budget estimate for the fiscal deficit. Now, the question being asked is, does the government invoke that escape clause? If the government invokes that escape clause, it has a very significant potential implication because the amendments to the FRBM Act had said that in the eventuality that the escape clause is triggered, the Reserve Bank may subscribe to the primary issues of central government securities. This is critical. We don't know if it will happen, but this is critical because India had moved away from what was called as automatic monetization of the deficit. If the escape clause is actually invoked, and if the RBI does buy primary issues of central government securities, then it is financing the deficit very, very directly, and that's not a good or a healthy sign at all. But let's get back to some of the other issues that are at play. When you get the fiscal deficit number, assuming it's 3.7 or 3.8, the debate about what the real fiscal deficit is will continue. Former Economic Affairs Secretary Subhash Chandra Garg, in a post had said that you need to add 3 items to the headline fiscal deficit. Some of those off-budget spending items like the bank recapitalization bonds should be added, dues to Food Corporation India should be added, and fully serviced government bonds should be added back to debt as well. So if you take all of that into account, the real fiscal deficit, according to Garg, would be around 4.5 to 5% in FY20. So I think if the government gives you a number of 3.7 to 3.8, there's going to be a lot of mathematics happening to understand what the real level of fiscal deficit is. That's certainly going to catch a fair amount of attention. The other thing that's going to catch a fair amount of attention is what is the level of nominal GDP that the government actually uses for its budget calculations. Last year it was 11. This year now growth has fallen to 7.5% nominal GDP growth in FY20. What will they peg it at in FY21? Most economists say that while the economy may have bottomed out, the recovery will be very weak. So even a 10% number will look lofty. Will they be realistic in setting their nominal GDP estimates? That'll something that'll get a lot of attention, and then linked to that, based on what your nominal GDP estimates are, you would be talking about what your budgeted growth in tax collections is. So if you have a nominal GDP projection which is very optimistic, then your tax collection growth will also look optimistic. On the other hand, if they're prudent in their nominal GDP estimate, then perhaps they will estimate for a lower growth in tax collections as well. Non-tax revenue far smaller, but this time around the focus will be on disinvestment, because in FY20 they didn't manage to meet their target. They've started some important divestment processes, including Air India. So it does look like they will have a large number there. They will not have a very large number on the RBI dividends part, because the issue over the RBI's capital framework has now been resolved. So from here onwards, it will largely be dividend business as usual from the Reserve Bank of India. Some of the sectoral issues that will be watched out for. There is large hope of a personal income tax cut. Whether it's possible given the fiscal constraints or not, we don't know. But if the consumers are under stress, well, at least the urban consumers, can you give them some relief through a personal income tax cut? Financial sector repair is top of mind once again. Very few believe that enough has been done between the government and the regulator to ease some of the financial constraints. Credit growth is still very low. So will they do something more to ease the constraints on the NBFC sector? The word bad bank has started to float around again. We'll see if something comes out of that. Allocation to support the rural economy will be important. The PM Kisan spends were not entirely used up in FY20. Will they budget a lower amount in FY21, or will they continue to make structural changes and ensure that a large amount of money does flow through to farmers via that scheme? There is also hope that you would see some announcement, at least for an intention to list on global bond indices. A lot of people are saying at a time when your domestic household financial savings are perhaps getting entirely taken up by public sector borrowings, you need to start opening up to foreign capital. And one way to do that is to list on global bond indices, which will bring in a large number of funds who have so far remained uninvested in India.
All right, so that's a pretty much holistic view of everything that could emerge in Budget 2020. But what are some of the country's leading economists expecting from the Finance Minister's budget speech? And that will come up in a few hours. Ira Dugal spoke to three of them last evening. Listen in.
Very clearly, we need, believable numbers. That's most important. Second is, I think we are putting too much on the budget day event. I think since July, we have seen more of budget making in the ensuing months than on the day of the budget. So am I expecting seriously big bang? Probably not. I think if they put 2 or 3 big ideas, I wouldn't even call them big bang reforms, but if they put 2 or 3 big ideas which actually can be executed and implemented, particularly on the side of investment push, I think that would be a good starting point, because at this juncture, what India really needs is, an investment-led, consumption, subsequent-led growth that should pave way for getting up to a 6%. I do agree that 6 to 6.5 at this current juncture looks a tad optimistic. Our own estimate would be at 5.7. But in terms of reforms, I would just expect them to, put those ideas on the table of execution, like a national infrastructure pipeline. What am I expecting out of it? What is the funding coming from? What are the sectors that are going to be looked at? What is the policy framework? I think we need reforms which are not comprehensive alone, but they need to be complementary also. A corporate tax cut, if it is accompanied with land labor reforms, etc., then makes a solid case of capex revival. But if it's a piecemeal approach, then the whole story and the whole plot is somewhere missing. And I would look at more complementarity aspect of reforms that would hopefully put the economy back on growth path, say up to 6% going into the next fiscal year.
There is no money, and in that light, any kind of announcements, etc., would could be aimed at a kind of revival of or boosting sentiment, confidence. But I think matters have gone too far now, and the state of economy is really bad. There is an intense resource crunch, so I think the wherewithals are just not there. A revival strategy in bits and parts isn't what is required as of now. A coordinated, package or a coordinated look macroeconomic thing with, part of monetary, fiscal, external sector, that is trade policy and exports, and it's something one can be looked at. But then, we are having a rise in import restrictions. We are having, more and more interventions and controls. So, that kind of coordination we have not seen. So I would not expect that tomorrow. I'm very curious to see as to how the arithmetic is reconciled, because that's where all the thing. But with all that situation, I think from a policy making standpoint, the only thing that the government should be actually looking at is how would it respond to if there were any kind of adverse shock? What are the tools that you have? What is the space that you have? And that's what is to be looked at in terms of going forward.
I think the government has already taken a call in some sense that the supply side is where the effort should be. Now, going into this budget, we've seen a deep slump in consumption. And if you look at the economic survey, they've also mentioned this particular aspect that consumption has been boosted or kind of supported by entirely a fall in households' investment in real estate. So it's kind of that income generation has not happened, and hence you've had savings being eaten into to fund consumption, and obviously there's a leverage consumption part. Now, going into the budget, you've already seen a series of supply side interventions. The point is that whether the budget can give some select focus demand side solutions. So and this does not mean that this is the end all of consumption stimulus or investment growth or anything like that. All I'm trying to say is that for the time being, there is a need for consumption to be boosted. And for the longer term, obviously the plan is very clear to get investment going, and hence which will create that virtuous cycle of growth and consumption, etc. So now the point is that this budget specifically needs to focus on this income generation or transfer, or in some sense, getting the consumption, possibly consumption at the rural sector going. Now, for that, of course, resources are extremely low and fiscal headroom is limited, which brings me back to your point that, when you're saying that escape clause, we all keep making that point that escape clause, and hence the primary, the RBI can get into the primary market of issuances and all. But the point is, it's supposed to have a fiscal council which will dictate whether the escape clause can be activated and how much of slippage is being done, and hence whether that the whole RBI buying into the primary, getting into the primary market and all happens. We don't have a fiscal council yet. But still, I think we'll possibly see a slippage from 3.3 to 3.8% in the FY20 budget. But I think in absence of that fiscal council or clear guidelines, in the sense that taking such a drastic step by the government, I don't think they'll probably get there in terms of the RBI coming and directly participating in the primary issuances. So I think there is a slippage that is happening to the extent that escape clause allows. But I think the RBI is not possibly being will be a participant in the borrowing and the primary market issuances that happen.
All right, now the economic survey released on Friday, that's yesterday, and it not only spoke about wealth creation, but it also had a very interesting term called Thalinomics. Nikunj Ori spoke to the government's chief economic advisor, Krishnamurthy Subramaniam, and he tried to find out the rationale behind the terminology and what needs to be done to make India a $5 trillion economy. Listen in.
In the last year's survey, we had made an attempt through the behavioral economics chapter to try and relate economics to the common person. This is something that we have believed in, which is that in a democracy, the economic policies, the more the common people are able to relate with, that actually helps the democracy. And food is something that every common person relates with, because we encounter that twice a day at least, if not more. And so in thinking about ways to explain something in a way that is easy to understand, because sometimes when, for instance, the other day my maid was mentioning that daam बढ़ गए हैं. So, this concept of a nominal versus real is something which is so fundamental to economics, that when nominal costs, let's say, go up, nominal wages also increase. And so we thought that this is a good way of capturing this idea, and in a way that the common person can relate with, and also have interesting conversations about. So not only about whether the prices of a thali has gone up or not, but is it more affordable? And that's why we've actually used the earnings of an average industrial worker and compared basically his or her earnings with what he or she would have to spend on a family of 5 individuals eating 2 healthy meals a day. So these are the ideas, which is to try and capture affordability of a very important element, which is food, and also to try and capture this notion of nominal versus real, and in some sense the concept of purchasing power, which is what finally one should be, focusing on. So these were some of the thoughts. We are glad that it has actually, it seemed to have been liked by some, by people. So it always feels very, very humbling and very satisfying to actually see some, an idea, sort of getting some traction.
So the survey also talks about a Temasek-like structure where the government's holding in all public sector companies need to be transferred to a separate entity, and this would require many amendments in the law. So how do you think this would be a better and efficient structure to privatize or sell government stake in public sector companies?
See, the broader point that we've made is that if you leave out some of the strategic sectors, in the non-strategic sectors, the private sector clearly is more efficient than government. And therefore, and we've shown a bunch of evidence, for instance, the BPCL versus the HPCL, where after the announcement of BPCL's privatization, the national wealth effectively has gone up by about 33,000 crores. And if you look at any of the entities that have been privatized in the past, if you compare it to the peers, in their industry peers, they perform well on several measures like return on assets, return on equity, net worth, bunch of measures. When you look at, they of course do better on average, but even in most cases, entity by entity as well, they're actually doing better. So given that evidence that clearly national wealth seems to get enhanced when efficiency is focused on, we've actually suggested one model, which is basically that of a holding company, and to enable better governance to come in, so that national wealth indeed gets enhanced.
Okay. So also, my last question, you've also kept your $5 trillion target for the economy intact, and you said we need to rely more on manufacturing growth. So do you think we need a relook when it comes to our manufacturing policy, and more needs to be done on that front so that we can actually manufacture more, and that would in turn create more jobs in the economy?
So I think on this we basically have said three things. One, in the second chapter on new firm creation, we've actually shown that if you take states which have flexible labor laws compared to those that have inflexible ones, new firm creation seems to be greater in states where the laws are flexible. Similarly, the ease of doing business is also something that enables new firm creation. And in that context, the second thing that we focused on is the specific suggestions on enabling ease of doing business by looking at various processes that go on. And the third thing that we've actually done is focused on exports and looking at that as a key vehicle for job creation by focusing on labor-intensive sectors. So these are some of the key things that we've actually focused on, in this context.
All right, now it's a special day today because it's not just the budget, we're also trading today, and that's unique. Darshan Mehta is joining me now to tell you all about this special Saturday trading session. Darshan, how are we looking at the start of Saturday, and also futures and options, how are they looking?
Yeah, so it will be weak. See, we don't have Asian cues currently, but the US markets were down 2%. Yeah. Europe ended down close to 2%, so there is weakness. SGX Nifty is open, so that gives a positive indication that we'll be down close to 40 to 50 points. So SGX currently indicating a negative outlook. It was down 67 points almost 15-20 minutes ago. Must have actually recovered a little bit, so there is traction. But remember, today it will be thinly traded, even on the international markets. How did we end up in trade? I think the trend somehow seems to be that the mid caps and small caps, the broader market seems to be showing much more traction. The Nifty was down almost 0.6%, cooled off significantly from the recent highs. Mid cap and small cap did well. The Nifty Bank and the Nifty PSU Bank did manage to move up in trade. Some of the PSU did well in trade yesterday, post the SBI numbers that came out. Now, in terms of how did the ADRs head out in trade, Vedanta was down 0.7%, not reacting too much to the numbers that came out. ICICI, Tata Motors reacted to its number. It was down 7% on the ADR side. HDFC Bank was flat, but the others pretty much flat in trade. So there was no traction that was happening. What led to our markets moving up in trade? First of all, FI youth sell number of 4,000 crores. DI has bought in 3,800 crores ahead of the budget. Now, what moved in our market? We were down 73 points. So the top two companies by market cap, Reliance and TCS, didn't contribute, and the largest company, probably second largest company on the Nifty Bank, ICICI Bank, didn't contribute. ONGC didn't contribute. Kotak, because of news specific movement, did manage to rally. SBI post the numbers, did manage to rally. So it was the banks that managed to hold on the Nifty, but otherwise there was selling that was happening. How did the futures and option market pan out in trade? We are at the 11,006. We are at the 11,900 mark in trade. Yesterday, fresh shorts were seen. Open interest built up was 12%. The Nifty trades at a premium of 32 points. The Nifty Bank did well in trade. There was short covering that was seen. Open interest was down almost 13%. So now let's take a look at where the positions are being built. Yesterday, put writers were much more active at the 12,000 level. So there is put writing that's happening. That's where the maximum amount of put writing is happening, and they expect the market probably to go up. And at the higher level, it's happening at the 12,200 mark. Even yesterday, it was basically the call writers which were active from 12,000 to 12,500. So at this point of time, it seems that there will be some bit of resistance that will come in on the Nifty at the 12,000 mark. At the lower end, 11,800 seems to be where support will come in. As far as the VIX was concerned, up 4% ahead of the budget. A little bit of volatility that happened. The other factors is how did the PCR pan out in trade, and because of excessive call writing yesterday, the PCR fell from 1.24 to 1.04. And finally, the stocks in focus yesterday. Oil India saw open interest build up of 86% on the short side. Bharat Electronics saw fresh shorts that were built in trade. Open interest build up was 77%. Again, selling in coal, NTPC, power. So all the PSUs yesterday saw major selling, and that has to be to do with the CPSC that's coming out. In terms of companies which saw short covering or long unwinding was seen on Escorts yesterday. Equitas also saw a bit of long unwinding that came in. Motherson Sumi didn't react much to the restructuring plan that came out, and Max India saw a bit of short covering that came in.
Thanks so much for that, Darshan. All right, now as we call for the government to react to the growth emergency in the country, we also reached out to some of the biggest voices from India Inc. and asked them each to give us an idea that they think can trigger growth. Here's what Sanjeev Bajaj, Baba Kalyani and V.S. Parthasarathy had to say.
One thing to do is to just put or create incentives for the average consumer to buy another house, to buy another car. So I would say cut GST on autos. You could cut it for 12-18 months. Yes, it will cause some bleeding. But if the economy picks up, growth picks up, your denominator will also go up. And your deficit as a percentage will come back in a couple of years. So I would say that is something to do. Second is, we have talked of Make in India. We want to bring the world here. We have to be consistent then across what we do when we want to attract the world over here. And why attract the world over here? How about attracting Indian business over here? So I would say that while the move on corporate tax was a good move, but just keep one low rate for everybody.
What will help the economy to a large extent is investment in infrastructure, which will create immediate demand for capital goods, which will make the economy in the medium term more efficient. I mean, what is infrastructure all about? Is to make the economy more efficient and make it more competitive. And I think that's the direction, at least from my sense,
that the government should take.
The government is taking or
Is
talking
taking?
about.
Well, what about should take? What's your idea for growth?
Should take. I mean, that's what they need to do. They need to put large amounts of money in infrastructure.
India can be the fruit bowl of the world, or food bowl of the world. Yeah, it can be the fruit bowl of the world. It can be the processing center of the world for agri and agri products. So can we put something, and if there's investment around those, again a private, public, and there will be huge amount of interest in it. And then if we put that and we put some money out of it, all it requires is velocity to be created. It doesn't require investment in expenditure. It is investment in creating such kind of zones. And if we do that, then it will start to kind of have multiplier effect.
On to stocks that you have to watch out for in trade today on account of them being in the news. Somit Sarkar has joined me to tell you about the stocks in news. Morning, Somit. What's on the list today?
Good morning, Alice. I'll start off with the earnings that came in post-market. Firstly, Vedanta, the results were above estimates. Ramp up in key businesses were disappointing for the company. Subdued commodity prices and lower volumes in zinc and oil and gas business impacted the revenue. Margins were aided by lower input costs, while the net profit was aided by an exceptional gain in the third quarter of financial year 2020. The company also said that they will acquire Ferro Alloys Corporation for nearly 280 crore rupees. Power Grid results were in line with estimates. Profits were aided by higher other income. Transmission segment revenue was up 7%. While consultancy and telecom segments were flat compared to last year. Castrol revenues were down 2%, EBITDA was up 7.5%, aided by lower input costs and good product mix, while the net profit of the company increased by 28%, aided by lower taxes in the third quarter of financial year 2020. AI Engineering revenues were down 4%, EBITDA was higher by 4.7%, net profit increased by 21%. Now the company saw a volume growth of 2%, while a 6% dip in its realizations. Margins improved due to lower other expenses and raw material costs, while the management has guided for a flat to marginal reduction in volumes for the financial year 2020. Shoppers Stop revenues were flat, EBITDA was up 2 times compared to last year due to Ind AS implementation. The company reported a net loss of 6.5 crore rupees as against a net profit of 42 crore rupees reported by the company last year, which was because of a deferred tax expense of 43 crore, which caused the loss in the current quarter for the company. In other stocks to watch, firstly, Divi's Lab, the Andhra Pradesh unit, has received 0 observations in the Form 483, which was received by the US FDA. Camlin Fine Science, because the China's joint venture manufacturing facility is restarting operation, has been delayed from Feb 2nd to Feb 10th because of the virus issues that we have been seeing in the country. And lastly, Eveready Industries, they have completed sale of its land at Hyderabad for 100 crore rupees to Newland Technologies.
All right, thanks so much for that, Somit. Now, Hindustan Unilever's third quarter results met street estimates. Volumes grew 5%, while margins in most segments saw an expansion. Agam Vakil takes us through the quarter gone by.
Right. Well, it was an inline earnings for Hindustan Unilever, and volumes were a notch higher than the Bloomberg poll. We saw revenues rise around 2.6% and with margins rising to around 24.9% against 21.4%. We also saw profits rise around 12%. Volumes came in at around 5% against the Bloomberg poll of 4%. We saw gross margins expansion of around 40 basis points. There was a lot of strength in home care. On the other hand, also on expected lines, personal care took a hit, and the management to a certain extent has partially attributed this owing to a delayed winter, which is why the stock left early, but well, the sales weren't up to the mark when it comes to personal care. Foods and refreshment, against expectations of a weak quarter, we actually saw a lot of strength come in with a growth of around 8%, and we've seen a reasonable margins expansion in all categories, despite the fact that there was a slackness in personal care. But on the whole, inline set of numbers, but no fireworks.
Yeah, Agam, good morning. I forgot to say that, but there's also ITC, and it turns out there was a bit of a bump in the margins, right? How does it compare to HUL though?
Well, of course, it's an apples and oranges comparison, but ITC has done, well, I would reckon, again, in line with expectations, also largely in tandem with HUL. Of course, the net sales rose around 5%. We saw, well, a good expansion in EBITDA margins as well on expected lines. It's the same for profit, though the profit number is looking slightly higher than expectations on account of a deferred tax write-back. Here, what really stands out is cigarettes coming in, and there are all sorts of estimates. The company does not give you the cigarette volume growth, but estimates are anywhere between 2 to 4%, and that of course is a positive as long as it's not flat or a decline. What we really saw a disappointment coming in the FMCG other space, because we were expecting about 5 to 6% growth, and the growth here is around 3.5%, and this is where the slowdown in consumption is very evident. Of course, on the other hand, what did come into play and, well, to counter the weakness was hotels business, which did very well, 22% growth in fact, and well, the agri business as well. So on the whole, it's been a mixed quarter if I just consider the growth for ITC, but well, the strength in hotels was countered by the weakness in the FMCG space.
All right, thanks so much for that, Agam. Now, it's budget day, you know that already, we've spoken about it. You'll find all the live coverage when market starts, of course, off the market, but also the budget speech will be live from 11 o'clock, and of course, all the analysis that follows all the announcements that will be made during the budget will follow the budget speech. Thanks so much for watching. Do stay tuned. We'll be live across the day.